We're seeing stocks down 2/3% or so at the S&P 500 index level, with technology leading things lower. And we've got a few things to talk about related to Google's disappointing news, something to watch with Oracle, and I'm actually going to show you just how much blood is in the streets at this point. And just a little sneak peek. It's quite a bit. We'll talk about all that and a little bit more, but before I begin, I must remind you this is a financial education presentation. You must do your own due diligence before acting on anything you hear in this presentation. More disclaimer information can be found on Ankerstarwealth.com, and the opinions expressed are mine alone. You know, the S&P 500 down a little less than 2/3%. That's really not crazy. If you actually look at the drawdown, the S&P 500 is 2% away from an all-time high. So again, it's nothing crazy. If you are levered or exposed to that high beta stuff out there, which we'll see in a minute, you could be feeling a bit more pain than an average investor. But of course, you had a bit more benefit than the average investor, as long as that's, you've been true to that for a long period of time. So nothing crazy there, especially at the index level, but it could end up getting to be crazy. So we'll talk about that in a moment. Rates, very steady here, nothing out of the ordinary. Oil continuing to tick higher. We've highlighted that you don't want to see too much of that. Gold can't quite hold 4,000, and then some of those cryptos that we were watching looking like maybe they wanted to show some signs of life. They are, maybe back asleep a bit, not showing as much life. Real quick, a highlight. You might some people might be looking at Netflix. Here's the thing about a Netflix right now. It's a great company. Netflix is no longer a fun company or a big growth company. Netflix is a mature beast of a company. And yes, they do operate in that content space, which is it's a tough space. Traditionally, content related stocks and even like content distribution stocks have not been the best companies to invest in. But Netflix is also just a streaky stock, in favor, out of favor, which that's a funny theme, right? Because we might be seeing a similar thing play out with some of the semiconductor stocks. Time will tell, but these stocks can be very streaky. If you bought Netflix in 2022 at, we'll call it $20, and you held it out to $100 per share, you might think it's the best company ever. And it is a great company, but it's just a streaky stock, and it's way out of favor right now. Probably because it's transitioning from a growth story into just a mature beast. And then they are going to have to figure out, and they're going to have to, investors are going to have to see, where does the growth rate level out at? How does the ad part of the business mature? Can they continue to stay on top of the content game? And then, how does that all compare to their peer group, which traditionally, again, not the best stocks. You go look at a Warner Brother, a Disney, you go look at all these content stocks, they just aren't the most desirable. It's almost in some ways like fashion brands, right? Like things can come in and out of favor much more quickly on the content side of things than maybe like with an Apple product, an iPhone, where you have a more sticky consumer there. Okay, I wanted to highlight that it is a popular company. If you want to talk valuations on a Netflix, here's the deal. The thing is $284 billion right now for the company. Remember, you don't want to be thinking about share price. You want to be thinking about the market cap. If we look at earnings, they don't even show you net income here. They're not deceiving, but you really need to see market cap and net income. That's what you'd like to see, the top couple of things. I think their net income is 15 to 16 billion per year right now, if I'm not mistaken. So You know, if you could get a Netflix at 250 billion, even if it's not as exciting of a company anymore, that would be a very attractive entry point, you know, in my humble opinion. Okay, now here we might be able to see net income. Nope, nope, we don't get it. It might be in financials though. I don't want to waste too much time looking at operating income. Yeah, it looks like 2025 was 11. I think they're about 15 right now. I think as of a 15 run rate. All right, what's going on in in some of this story? So why is tech selling off like this? Well, yesterday Google came out and said that its new AI model is delayed. It's delayed by months, um, and it's not performing according to their internal expectations. There are multiple problems here. Google is spending last I saw, $185 billion this year on AI development. If you are spending $185 on anything, that thing better not be delayed and it better not fall short of internal expectations. There's no investor is going to excuse that. So investors are rebelling a bit on the Google specific side, but it's bleeding into other things. So if you look at it on a 1-day basis, this is today, you're seeing everyone get hit. And I think some of this is, if Google is investing 185 billion and they can't get it where it needs to be, well then Meta, they're only investing 120 billion. They probably have a less of a chance than Google. And you know, who else is affected? Well, if all this investment isn't bearing returns and progress that is aligned with these companies' goals, well, then they're going to probably stop spending as much, right? If they're not even hitting their goals. So Broadcom, Micron, AMD, you know, everyone gets wrapped into that. And I want to show you one more thing. And here we do see the S&P 500 was down 1% and it started bouncing back. And what you did highlight, one of the problems with that is if you're gapping lower every night and having to fight your way back, people are exhausting a lot of, you know, ammunition and things to get that and capital, that energy, right, to just recover. And eventually they might start running lower and lower on ammunition. We'll see. But then, you know, also we did mention too, some of these companies, people were in AMD so they could have fun. Well, they might not be having that much fun anymore in some cases if they bought in kind of late. And if they aren't having fun, then they're not going to stay. So yeah, if Google is falling behind, delaying models, and they aren't seeing what they need to see, then that could bleed into the entire AI infrastructure. And then I want to highlight one more thing. This is your drawdowns. Look how far some of these stocks have fallen from their all-time high. Western Digital almost down 50%. That's that's that memory space. You know, you've got Intel 36%. Intel has been extremely hot. Marvell down 45%. How long ago was it when we heard that Marvell was going to be the next trillion-dollar company? Now they're down 45%. Okay. So some of these companies, if investors came in late, and I could show you those VWAPs where who's having fun, who isn't, but if someone came in late on some of these, they are having zero fun. They're actually experiencing great pain. And what did we say at the beginning of the show? The S&P 500 is only down 2%. So the folks aren't going to have a lot of patience here. That'd be my opinion. Now, who's down a lot, right? You have Oracle. Okay, Oracle has taken on significant debt to build out data centers that they're going to lease and all of that. If Oracle, so the market is saying there's real risk here, and Oracle does have existential debt risk at this point. the market is saying by the stock price, action being down 64%, the market is saying that we aren't totally trusting what Oracle's doing here. Now let's extrapolate that out. What if Oracle really does have a really disappointing, let's say, a couple of quarters with either revenue or signing new clients or leasing these data centers or even bringing them online? What if they've taken on all the debt and can't even bring them online? They're waiting on energy or waiting on memory or waiting on something else. And let's say Oracle does run into some debt problems, and maybe they even have to sell a few data centers or flood the market with some of these supplies that, remember, they're one of the biggest buyers of all these chips and memory chips and everything, and using debt to do it. So if there is a hiccup there, there's the potential for some extra supply to hit the market is really the kind of the takeaway there. All of these things, Google delaying things, even if Oracle had to sell some data centers related to debt, it doesn't change the ultimate outlook for AI and what's possible and what the future looks like. It just changes the financial picture in the short to medium term. So it really isn't a deterrent for a long-term investor. The real problem would be if somebody just got overexposed to the wrong thing at the wrong time, and that again kind of brings it back to just know who you are as an investor, your philosophy. Obviously, we have that at Ankerstar Wealth, and follow through with that. So know those things, stay committed to those things, and you don't need to give up on a Google because they delayed a model, and you don't need to give up on, if you've owned Western Digital for a long time and you still like where the memory space is at, you don't need to give up on something just because it's down 45% in a couple of weeks. That's just part of your where and how you invest, right? If you are a momentum investor, then of course that's a different thing. You'd be in and out of these things very frequently as a result of that. Hey, thank you so much for joining us today. Do you think it's a big deal that Google's models are delayed? It is very unfortunate and it's kind of inexcusable, but it's not the end of the world in my opinion. Hope everyone has a wonderful day. Of course, look forward to talking to you soon.